Have you ever wondered how major projects get funded, or where governments find the money for infrastructure, or how businesses expand and innovate? Understanding the core players in this complex system helps illuminate how economies grow and thrive. In capital markets, the primary participants are fundamentally divided into two main categories: the suppliers of capital and the demanders of capital. These two groups are essential for facilitating the flow of long-term funds within an economy, allowing for investment and growth. The reason these two groups are primary lies in the fundamental economic principle of resource allocation over time. Capital markets exist to efficiently connect those who have excess funds today with those who need funds for future productive investments. Suppliers of capital are typically households who save a portion of their income, and businesses that retain earnings for future growth. They are looking for a return on their investments. Demanders of capital are primarily businesses seeking to fund expansion, research, or operational needs, and governments that issue bonds to finance public projects or cover budget deficits. This interaction ensures capital is directed where it can generate economic value. These participants interact through various mechanisms. Direct finance occurs when suppliers lend directly to demanders, such as buying government bonds or corporate stock in a primary market. More commonly, they engage in indirect finance through financial intermediaries like banks, mutual funds, or pension funds. These intermediaries pull capital from many small suppliers and then lend it to demanders, diversifying risk and reducing transaction costs for everyone involved. They also operate in secondary markets, where existing securities are traded, providing liquidity for investors. An important insight in capital markets is the concept of market efficiency, which suggests that all available information is quickly reflected in asset prices. This means that participants, both suppliers and demanders, are operating in a highly informed environment, making it challenging to consistently achieve above-average returns without taking on greater risk. The efficiency of these markets ensures that capital is allocated to its most productive uses based on current information. Ultimately, understanding the roles of capital suppliers and demanders, and the ways they interact, provides a clear picture of how economies mobilize savings into investments. This dynamic flow of funds is critical for economic development, job creation, and fostering innovation, ensuring that resources are continuously recycled and optimized for long-term societal benefit.